So I have a lot of oak trees around my house, and everything is covered in pollen right now. We're in April, but it was fine this time around. Every year I hate it, but this was fine because I've been reading a lot of stuff about a different kind of oak tree in anticipation of this episode, and I feel like we timed it just right. So I felt happy looking at all the pollen everywhere outside.
Yeah, that's funny. Actually, I nerded out on oak trees too. It's an example of like the random rabbit holes we go down when we prepare. And fun fact, 40% of the trees in Connecticut are oak trees, and the state tree is a white oak. So
Oh,
I
there you
also
go.
apparently love oak trees.
It's all about oak tree. You ready?
Let's do it.
Welcome to the 6th episode of Season 2 of Backtest, the podcast about defining moments in market history and their timeless lessons. I'm Daniel Gamboa.
And I'm Matt Harris.
And we are your hosts.
Before we dive in, a quick reminder that this show is for informational purposes only, and it isn't investment advice. Daniel and I may have investments in the companies discussed.
What is it that distinguishes the thousands of years of history from what we think of as modern times? The answer goes way beyond the progress of science, technology, capitalism, and democracy. The distant past was studded with brilliant scientists, mathematicians, inventors, technologists, and political philosophers. Hundreds of years before the birth of Christ, the skies had been mapped, the great library of Alexandria built, Euclid's geometry taught. Demand for technological innovation in warfare was as insatiable then as it is today. Coal, iron, oil, and copper have been at the service of human beings for millennia, and travel and communication mark the very beginnings of recorded civilization. The revolutionary idea that defines the boundary between modern times and the past is the mastery of risk. The notion that the future is no more than a whim of the gods, and that men and women are not passive before nature. Until human beings discovered a way across that boundary, the future was a mirror of the past, or the murky domain of oracles and soothsayers who held a monopoly over knowledge of anticipated events. That is from a book called Against the Gods, The Remarkable Story of Risk by Peter Bernstein, one of my favorite books of all time, and as it turns out, also one of the favorite books of one of our protagonists today, Howard Marks.
Yeah, so that book actually it came out in 1996, and I can only imagine how Howard was just lighting up when reading it after being one of the few people who put these ideas into action in the period of market history we're going to talk about today.
Yeah, today's story, the final chapter of our 80s on Wall Street series, is going to put a bow on the series by linking everything we've covered so far, the rise of high-yield bonds and private equity, the deregulation of financial markets, the huge capital flows into these new asset classes. And we're going to bridge from the 80s to the 90s and really to modern capital markets by following Howard Marks and Bruce Karsh as they become key players in high-yield bonds and distressed debt.
And so whenever Howard or Bruce come up, I usually explain them as the Warren Buffetts of the debt investing world. I think Warren Buffett's a little better known by the average person, probably just because equities are sexier than debt. But I would say Howard and Bruce are his equals in their success and their reputation, but also in how they've educated the market on risk management and how to think about investing. Warren through his shareholder letters and annual, big annual meetings in Omaha, and Howard through his memos and his books. So not only are Howard and Bruce legendary investors who built one of, really, if not the premier credit investing firm called Oaktree, they're also the source of how a lot of credit investors think about investing and managing risk.
In fact, Warren Buffett has endorsed Howard Marks' writing multiple times. One of the official quotes from Buffett is, quote, "When I see memos from Howard Marks in my mail, they're the first thing I open and read," end quote. So, high praise.
Yeah, that's about as good an endorsement as you can get. And I've been excited to tell this story since we started the show.
Yeah, we'll let that excitement build for another 30 seconds, because before we jump in, we'd like to thank EQT Corporation for helping us bring you the stories of market history.
At Backtest, we study market cycles because patterns from history rhyme. Whether it's unlocking capital with high-yield bonds and private equity or unlocking energy needed for AI applications, understanding history gives you an edge.
That's right. And the company unlocking energy to power AI is EQT, producing American natural gas to help deliver affordable, reliable energy at scale. All right, let's dive in. I was going to suggest that we start at the beginning, but I'm going to throw you a curveball today, Matt. I want to pick up right where we left off in part 4 and let everyone listening into the thought process that led into this story, because there's a question that I kept coming back to during our research since we started the series. We told the story of Michael Milken, right? He's the architect of the high yield bond market. He generated extraordinary returns following the analysis outlined in Braddock Hickman's work. And depending on your interpretation of what happened next, he either had lapses of judgment, right, that led to his downfall, or he was just scapegoated.
Yeah, probably a little bit of both. But Michael Milken's story, it's a great one. Either way, lots of lessons for both investing and life.
Yeah, and then we also told the story of Fred Carr, right? He took Milken's product, went all in, failed to manage his downside risk to the point that he drove one of the biggest insurers in the U.S. to bankruptcy. So to me, the obvious question is, was anyone doing this well, right? Like, was anyone being thoughtful about capital allocation and risk management and portfolio construction? Or maybe more simply, did anyone deliver what we might consider a successful outcome here? Well, the answer to that is yes, and it's not just one person, as you alluded to at the top, it's two. It's Bruce Karsh and Howard Marks.
I'm particularly excited to tell the story of Bruce Karsh. Howard is the front man of the team, so he's better known, but they really are a team. And I thought a little bit about, like, what's a good comparison? And I think Sherlock Holmes and Dr. Watson are the best comparison. Everybody knows Holmes. They think he's a genius, but Watson is just as key to success as Sherlock Holmes.
Yeah, I love it. And keeping with our little Buffett analogy from the top, right? These two are arguably the credit investing equivalent of not just Buffett, but Buffett and Munger, Charlie Munger. In fact, similar to Buffett and Munger, where Munger is 7 years older than Buffett, Howard is 9 years older than Bruce. So with this whole thing as our little preamble, let's start at the beginning with some context. So Howard Marks is born on April 23rd, 1946, which means he's almost exactly the same age as Michael Milken, born the same year, within a few months of each other. Howard is from Queens, New York. His father is an accountant. His parents came of age during the Great Depression. And similar to a lot of people who lived through that, their experience colors how they think about the world. So in one of his memos, Howard says, quote, "My thought process was shaped by the deprivation and fear they had experienced," unquote. This reminded me of our conversation with Bob McNally a couple of weeks ago, and in particular his comment that trauma is a more powerful motivator than almost anything else. This is the kind of thing he's talking about, I think. So, part of that same mentality, Howard grows up with a big emphasis on education, and at some point he wants to be a historian, at another point an architect, but as he gets ready to apply to college, he decides he wants to study accounting, like his dad, and he wants to do it at the Wharton School, the University of Pennsylvania. His high school counselor basically tells him, you don't have a chance of getting in, which is pretty rough advice from a counselor, or maybe he was just, tough love. But a tennis coach of Howard's encourages him and even writes him a letter of recommendation. Ultimately, Howard does get in, and he enrolls at the Wharton School in 1963. 4 years later, in 1967, he graduates, not as an accounting major, but as a finance major. He applies to Harvard Business School and gets rejected.
Like Buffett. Buffett also got rejected from HBS.
Sure did. And instead of going to Columbia like Buffett did, Howard goes to the University of Chicago for his MBA. And remember, Buffett ends up meeting and working with Ben Graham at Columbia, which is a huge inflection point in investing history that we'll have to cover in another series. Somewhat similar, Howard is going to Chicago right when Eugene Fama is formulating the efficient market hypothesis there. This is the idea that markets are essentially perfect, that all available information is already reflected in prices, and therefore it's basically impossible to consistently beat the market, right? This is the golden age of Chicago with Milton Friedman and Fama and others that are there at the same time. So Howard takes this idea very seriously. He uses it, but something doesn't sit quite right with him. And he's going to wrestle with this for the better part of his early career. Basically, this idea that there's often places where efficient markets break down, where there's information that gets ignored or it's incomplete, or there's stigma causing irrational pricing, or there's institutional constraints driving forced selling like we've seen, right? If you've been paying attention, you know that the high yield bond market in the 70s and 80s, at least in the early 80s, fit that description perfectly. And Howard is eventually going to find his way there. But before all that, after he graduates from Chicago, he joins Citi in 1969 as an equity research analyst, and he's about to run into the herd mentality, chasing these 50 stocks, these like 50 can't miss, great company, no price is too high kind of stocks, also known as the Nifty 50. And Matt, investors in the 60s and 70s aren't dumb. Why did people believe that they should buy these companies at any price, no matter the multiple? The multiples are insane in hindsight.
Yeah, they do get pretty crazy. But if you put this period in its market context, we can at least make sense of it. In the Fred Carr episode, we talked about the go-go era for stocks, which was the mid-1960s. And this was the first real wave of institutional momentum investing, where specifically mutual fund managers were trading in and out of small, high-growth companies, really chasing near-term growth and multiple expansion. And when interest rates rose in 1968, those companies were small and fragile, and so they cracked and the go-go strategy blew up, and Fred Carr blew up at Enterprise Fund. This was before he went to First Executive as the insurance CEO. But at that time, the lesson investors took away wasn't that, growth investing sucks. It was that the go-go investors had picked the wrong kind of growth, and the next iteration would focus on durable growth and investing in the highest quality companies in America, which, sounds awesome, right? That's a great conclusion to draw. This seems like a really positive market shift. And so the go-go era ends in that 1968, 1969 time period, right as Howard Marks is graduating from University of Chicago and joining Citi. And the market really coalesces around a new idea, which is let's buy the best businesses in the world and hold them forever. And this became known as the Nifty 50. Like you mentioned, this is companies we still think are great, right? It's IBM, it's Coke, it's McDonald's, Procter and Gamble.
Yeah, some of them, right?
Right. And the tagline of this era is one decision stocks. You make one decision to buy and you never sell. And it's important that to note that like this period didn't start in a bubble. In the late 1960s, you were just buying great, high-growing companies, compounders, as Buffett would say, at 20 to 30 times earnings. And this is totally reasonable. But between 1968 and 1972, that idea started to morph into, let's buy great companies at reasonable prices to like, doesn't matter what the price is.
Which, by the way, Matt, that's a very Munger concept, right? I mean, that's
Right.
something that Munger has educated us all on now. But, it was a very sophisticated idea back then. But that goes out the window.
Yeah. So everybody crowds into the same 50 companies. No one is selling. Multiples expand to, 50 to 60 times earnings. Famously, Polaroid trades at 90 times earnings. And at the peak, these Nifty 50 stocks are about a third of the stock market. And it's really important to note that in this case, the buyers are not retail speculators or even mutual funds. The buyers for the Nifty 50 are institutions like pension funds and insurance companies, where the incentive for them, especially at this time, it wasn't to be right because you're not really compensated to be right. The incentive was to not be wrong all by yourself. And so owning the same stocks as everyone else was very career safe, especially when those stocks are objectively great companies, producing 15% annual returns in the early 70s when the overall market's really only doing 5%. So it kind of makes sense as you come into like the 1972 time period. What happens is like macro rears its head in like a massive way. Inflation starts rising into the double digits in the early 1970s. Interest rates go way up to try to bring inflation down. We get an oil crisis in 1973. This is the Yom Kippur War oil crisis that sends oil from $3 a barrel to $12 a barrel. And you get a really bad bear market in stocks in 1973, 1974. Stocks fell 48%. At that time, that was the worst decline since the Great Depression. And just to put it in kind of broader context, it's about the same as the peak to trough of the tech and telecom bubble when after that burst and when 9/11 happened. After this big macro event, the no one sells the Nifty 50 belief breaks, and the highest priced stocks have the furthest to fall. So you have stocks that are priced at 60, 70, 80, 90 times earnings that now need to normalize to like 10 to 20 times earnings. And so it's important to note, right, these businesses didn't fail. These businesses were probably still doing just fine. Coke keeps growing, IBM keeps growing, but the multiples collapse. I can only imagine what it would have been like working at one of these companies during this time.
Scary.
When you're like, wait, we're doing great and our stock's down 90%. Like, what is going on here? Polaroid famously fell 90% during this market period. And so this time period really sears some important lessons into Howard Marks, and it becomes foundational to everything he does. And that lesson is really simple one. It's not what you buy, it's what you pay. And that great companies can be terrible investments if you overpay.
Yeah, I mean, price is not the only thing, right? But as Howard might say, it's the most important thing. Yeah, see what I did there? Yeah.
Nice. Yeah.
All right, for the uninitiated, that's the title of Howard's book, where the most important thing turns into 10 or 15 most important things. So, okay, back to the story. So by this point in 1975, the Nifty 50 thesis has been completely discredited because of that performance. 90% losses will do that to any strategy. Howard, meanwhile, is the director of research at Citi. And this episode is the career equivalent to the Great Depression for Howard in terms of the kinds of lessons that he just seared in his memory from the trauma of all this. It makes it very, very obvious for him that price matters, that you can think very highly of a business, and that business can still be a terrible investment if you pay too much for it. And importantly, the collapse is pretty rough for everyone involved. The way Howard frames this is interesting. He makes a point of saying that in the 70s, companies were very different. You stayed at one company for your entire career. They weren't quick to fire anyone. And it's hard to say for sure whether Howard takes some flack for what happened with the collapse of the Nifty 50, but he gets moved to the bond department, which he describes as Siberia. So not great, seemingly. But as bad as that might sound, he also says that he is ecstatic because rather than manage a big staff with a big budget, he has 40 securities, and his job is to dive deep, understand all of them better than anyone else, and just go to work on them, right? Well, I want us to hold that thought and divert a little bit, because as important and prominent as Howard is to our story, there's another guy who probably doesn't get enough public credit. Let's talk about Bruce Karsh a bit. So Bruce is 9 years younger than Howard. He's born in 1955, grows up in St. Louis. Bruce is pretty private, so from the limited amount of information about him out there, his family was also big on education, also, hard work and achievement. He studies economics at Duke and graduates near the top of his class in 1977, by the way. I think that's 3 years earlier than Aubrey McClendon, so they almost overlapped.
Nice,
an interesting pair.
Good find. Yeah. Yep.
He goes straight to law school at the University of Virginia. He always wanted to be a lawyer. He's following the path to a T. He's exceptionally good at it. He edits the Virginia Law Review, graduates with honors, and then he clerks for a year for then Judge Anthony Kennedy at the Ninth Circuit Court of Appeals in California. This is, of course, eventual Supreme Court Justice Anthony Kennedy. So needless to say, Bruce is on the superstar lawyer track very early in his career here. He joins a blue chip firm in Los Angeles, actually at the recommendation of Anthony Kennedy, who had noticed that Bruce was really inclined towards business deals and business transactions. But despite all that, Bruce is not satisfied with the partnership track. He's a bit restless. He's been at the firm for about 3.5 years when he gets a call from billionaire Eli Broad, who's looking for a general counsel for his holding company, which is this big company. He had an insurance firm, he had a home builder. And by the way, at this point, Bruce is in his 20s. So he's, I think, if I'm doing the math right here, he's about 29. After a few minutes of talking, Eli actually offers him not the role of general counsel, but a role as his assistant on investments. So basically, Eli wants Bruce to come help him make investments, to help him structure transactions. And he makes it really compelling. He says, I'll pay you 50% more than what you're making at the law firm. So, even though Bruce says that Eli had a reputation for being hard to work for, he steps off his linear career track and takes the step towards becoming an investor. And he doesn't know it at this point yet, but he has an edge because his training is perfect for what he's about to embark on. Meanwhile, going back to Howard, he's still working as director of research at Citi, just started a new fund for convertible securities. And by all measures, he's doing okay. And in 1978, his boss tells him, quote, "There's some guy named Milken who works for a small brokerage in California. He deals in high-yield bonds, and a client wants us to manage a portfolio for them. Can you find out what they are?"
Howard frames this when people ask, like, why did he get the question? Howard says it was because he probably was underemployed, right? He was being very highly paid, but at this point, but only covering these 40 companies. And so that is an interesting, path to what eventually becomes Howard Marks here, as he was apparently underemployed for a short time.
Yeah, anybody familiar out there who doesn't know this story is probably like, whoa, that's a That's a major inflection point. What would the market be if it weren't for that? And if you've never studied this period, then well, you're about to find out why this is so important. In Howard's 2007 memo titled "Everyone Knows," Howard says that this brief conversation changed his life. And we don't know who the client was, which is another interesting piece, maybe lost to history. We'll have to ask Howard sometime. But we definitely know who this guy named Milken is, right? We studied him in part 1. I bet this feels like a bit of a curveball for Howard, but I also bet that he was excited to dig in. It's this new corner of finance. He's the guy that's been questioning the efficient market hypothesis, right? Like he's looking for interesting opportunities that maybe other people have not necessarily dove into yet. And so remember, at this point in the bond market, you're either investment grade or you're not. And if you're not, you don't get to issue public bonds. So really, these are mostly fallen angels with maybe a handful of new issues in 1978. And the official label from Moody's, the rating agency, for non-investment grade bonds, and this is, by the way, something that Howard loves to quote, the label is, quote, failing to possess the characteristics of a desirable investment, unquote, which is almost like a moral judgment, right? Like serious investors don't buy these.
Yeah, when we were getting to know what this market was like in the late 70s, early 80s, my first response was it feels like crypto, right? It feels like crypto, but without Silicon Valley. Like it was just kind of dirty, and real investors don't get involved in this. It's kind of what high yield felt like at this time.
That's right. Yeah. So maybe begs the question, right? Like, why does Howard's boss ask him to go check this out? You're speculating that we don't really know, but maybe he was underemployed and that's why. Either way, Howard is primed for this. He dives into it. Michael eventually comes to visit Howard at Citi in the fall of 78. And by this point, Michael has already made a name for himself. He's not this big titan of finance leading massive deals. That's later on in the 80s. But by this time, he's already set up shop in LA. He's proven his thesis. He's built his trading team. And he's starting to underwrite new issues of high yield bonds. And so Howard's meeting with Michael at the perfect time. It's still early. Michael has proven the thesis, but the market hasn't been scaled up yet. And apparently Michael tells him something like, quote, if you buy single B bonds and they survive, all of the surprises will be on the upside, unquote.
Yeah, just to explain a little bit of what Michael is saying to Howard here. At this point in 1978, the new issue market is still pretty small. There's $1.5 billion of new issue in 1978, so very small. So Michael is mostly talking about buying fallen angels trading at big discounts in the secondary market. That's about an $8 or $9 billion market in 1978. So what Michael is saying here is that these bonds are priced in the market at a price that assumes the chances they go out of business are really much higher than they have been on average throughout history. So you're paying this really low price, a much lower price than is justified for the probability of a default or a bankruptcy. And when that's baked into the price, really anything that happens from there is just upside. Any surprise you get is upside. The expectation is that these companies are going to default, and that's how they're priced, even though they're probably not going to default.
It's almost like they priced in a worst case scenario already. And this definitely clicks for Howard at this point. It's kind of the Nifty 50 lesson in reverse, if you think about it, right? The Nifty 50 were overpriced. They were priced to perfection. But these high yield bonds seem to be way underpriced. Like investors are pricing the Nifty 50 as if nothing could ever go wrong, but they're pricing these bonds as if everything was guaranteed to go wrong.
So it turns out that high yield, this new market that Howard Marks is exploring with Michael Milken as his guide, are really the perfect intersection for Howard Marks and his background as an equity analyst and his naturally conservative temperament that was really shaped by his Great Depression era parents that we talked about earlier. Up until this time, debt investors didn't really do deep analysis because the whole market was investment grade. And you can look at an investment grade bond then and now and say, look, these are safe. They pay a spread over treasuries. And if something starts to go wrong with these investment grade bonds, there's usually a ton of liquidity. And so you can sell them for like a small discount and move on with your life without taking much damage. High yield is totally different. Actually, one of the debates that lasts into the 90s and even the early 2000s is if high yield is equity or debt. Right? It wasn't clear, what is this new thing? Is this debt or is this equity? And accountants and regulators and the media were having that debate openly during this time. With high yield, you have to actually think and do real analysis. What is this business worth? Can it grow into something stronger? And really important, does the yield or the return being offered compensate you for the risks you're taking that the business doesn't grow into something stronger? At this point in history, that thinking wasn't a bond investor skill set. That was an equity investor skill set. And Howard had already been classically trained as an equity analyst, so this comes very naturally. So even though Howard had learned how to do equity analysis, his natural temperament, his natural way of being that he learned from his parents and from the Nifty 50 days was to say something like, sure, like I see this as a solid high growth company, but what can go wrong here? What are the chances of that happening? And am I being paid enough to take the risk that something's going to go wrong?
Yeah, he's focused on the downside, right?
Right. So that mindset maps perfectly to high yield. And for Howard, this is the moment where it all clicks. He probably had some pretty awesome sort of flow state moments in the late 70s and early 80s where he's at his desk doing his work and he's like, man, I have found my thing. This is what I was made to do. And so he leans in. He moves to Los Angeles in 1980 to be closer to Drexel and Michael Milken. And this is a big move, right? Howard Marks is a Queens, New York boy, and he's married to his wife Nancy at this point, and they have kids. And so he moves to LA. He launches one of the first institutional high yield portfolios at Citi at a time when this market is tiny, right? There's maybe 10, there's probably less than 5 institutional funds in the high yield space at this point, and it's still widely viewed as a backwater. So this is a big bet, both personal and professional, that this sort of undesirable, Siberia corner of the market is going to generate attractive returns. And that by getting in there and doing the work of an equity investor, using your equity analysis, but to study the downside, Howard thinks he can carve out a space for himself in the world. And with that, this is a great time to thank our presenting partner, EQT.
Yes. One of the themes that comes up again and again in these stories is the importance of using data and analysis to understand what's really happening and how things work to avoid biases that cloud your ability to make good decisions.
Everyone's talking about affordability these days, especially energy prices and how the AI build out might impact them. When you look at the data, it all comes back to infrastructure.
Yeah, I mean, energy markets are all about supply and demand. Our recent interview with Bob McNally made that crystal clear. Demand for energy is rising, and it doesn't turn off just because we don't have enough energy. I mean, I live in Houston. I need AC in the summer, right? I need light. I need hot water. We all do, which means we need enough energy supply to meet the demand. Otherwise, prices spike to try to balance the market.
That's right. That's why EQT is helping educate consumers and policymakers on what drives affordability in electricity markets across the U.S. The data is striking. Since 2020, states like Massachusetts, California, Connecticut, and Maine have seen electricity prices rise roughly 3 times faster than the rest of the country. This is fundamentally an infrastructure problem. The natural gas to generate power is available. We have the supply. The issue is that the regional pipeline projects have been canceled or blocked. Permitting takes years, and that means energy supplies can't go to where the demand is growing.
Yeah, this is a problem with a very straightforward solution. As a country, as states, we need to be able to build. To learn more and explore the data yourself, go to eqt.com/energy-affordability. That's eqt.com/energy-affordability. Big thanks to EQT for helping us bring you the stories of market history and how they apply today. So back to the story, Matt. By 1985, Howard has been running Citi's high yield operation in Los Angeles for 5 years now. He had come to Los Angeles, like you said, in 1980 to be closer to Milken's machine at Drexel. And during that time, he's built an institutionally managed high yield portfolio at one of the largest banks in the US. The market around him has scaled up quite a bit and is still growing. When Howard got the assignment in 1978, the high yield market was about 10 billion plus or minus. By the mid 80s, it's closer to 100 billion. Michael Milken is issuing new bonds. He's the go-to market maker. The leverage buyout machine is cranking, and capital is coming in from insurance companies like First Executive with Fred Carr and from savings and loans institutions, the S&Ls. Siberia, the way we've been labeling this, based on Howard's quote, became Hollywood to some extent. And this is the hottest market on Wall Street with some of the biggest bonuses in the mid-80s. But at this point, Howard actually decides to leave Citi.
Yeah, although the market had grown a lot and people were making a lot of money, a lot of the old money firms like Citi still thought it was immoral and it was being bashed by the media, and regulators were starting to pay attention to it and probably try to take it down. And so Citi was actually getting out of the high yield business, and Howard was one of the last people to stay in the high yield department, and then finally he leaves.
Yeah, and we're calling this high yield because that's how we call it now. But in mid 1980, 85, This is called junk bonds. You can't get away from the label and the stigma. So after 15, 16 years at Citi, Howard makes the move to a company called TCW, the Trust Company of the West, which is also based in Los Angeles. It's an asset manager. And the mandate for Howard joining TCW is to lead the groups responsible for high yield bonds and convertible securities. He also takes on the role of chief investment officer for domestic fixed income, which is a significant expansion of scope from what he had at Citi.
TCW, Trust Company of the West, they're not a Wall Street powerhouse like a Citibank or a JP Morgan or even a Drexel by kind of the mid-late 80s. But they're a serious institutional manager with real credibility, managing money for pensions and endowments, and they're really known for being, very thoughtful and not really flashy, not a flashy place.
Right. And for someone who has spent, 7 years proving that high yield is a legitimate asset class, my guess is moving to TCW must have been a chance to build something at a different scale, right? Something bigger. And this is where Bruce Karsh re-enters the story. Remember, back in the early 80s, Bruce had stepped off the rockstar lawyer path to go be the right-hand man of Eli Broad, analyzing and structuring investments and transactions. Well, Eli, through his insurance company, had gotten involved in an asbestos manufacturer called Johns-Manville. And this was a Fortune 500 company. So it was a very big company back then. In 1982, Johns-Manville had filed for bankruptcy because it was facing over 10,000 health-related lawsuits. Eli basically hands Bruce the file for the company and tells him, hey, go figure this out. You're a lawyer/investor, go figure this out. And Bruce is perfect for this, right? He's ready. If you know anything about bankruptcy and restructurings, you know how it's a perfect blend of very rigorous legal maneuvering and investment analysis. So it's the two skills that Bruce brings to the table that he's really, really good at. And Bruce says in an interview that it was really intriguing for him because there were bonds that were trading at a discount and the stock was basically an option. And so after doing some work, Bruce tells Eli, hold the stock and buy the bonds. And this is what ultimately becomes distressed credit investing, but it's not really a thing yet. This is like one of the first deals where Bruce is looking at this going, everybody's running away from these firms that are maybe going bankrupt, but you can actually make money on these. There is still potentially good assets and maybe even a good company underneath this broken balance sheet. To me, this is a bit of the equivalent to the bootstrap deals before KKR that they were doing at Bear Stearns before all the big LBOs.
It makes me wonder what people were doing with bankruptcies before this, right? It's just kind of like, it's over.
It's over. Yeah.
Next.
Wrap it up. Yeah. Throw it in the trash. So anyway, this is on Bruce's mind. Then these two guys, coincidentally, Randy Smith and Basil Vasilio, come into Eli's office and pitch Bruce and Eli on a $40 million distressed debt fund sometime in the mid-'80s. And this is the first fund of its kind. They end up passing. Bruce and Eli pass on this. But Bruce says that this really stuck in his mind. It's like, oh, there are people actually doing this as a strategy, not as just one-off investments here and there. And so the other thing that was happening too is that we talked about this in parts 2 and 3 with RJR. Bruce is seeing the LBO boom, the leverage buyouts happening in real time. He's investing in some of them, and he's seeing the prices go up and up and up with more and more leverage. And he starts thinking, maybe distressed securities will become a thing, right? Especially if there's a recession. There's no way that these companies won't eat through the tiny sliver of equity. And, there's no way they won't need to restructure all that debt. And so I should note that no one was really thinking like this, really. But this idea of thinking about the downside and being fearful when others are greedy and thinking about cycles in particular, put a pin on that, because this is a key character trait for both Bruce and Howard.
Yeah, I think at this point in the 80s, 86, 87, it's worth mentioning that Bruce and Howard are definitely seeing some yellow lights flashing in the cycle at this point. Even if they don't know when things will turn down, we know that these guys are thinking in cycles. Some examples of yellow lights flashing in like 1988, for example, was that the economy was actually in its sixth year of the longest period of consistent economic growth since World War II. And the Fed is actually raising rates to cool things off, which had to feel a little weird to some people with Black Monday, just right in the rearview mirror. Like 6 months ago, we had the worst day ever in market history, down 22.6%. And now the Fed is already kind of back into a hiking path. Returns on high yield bonds had been really, really good. Actually, they've been better than equities since the end of the 82 recession. and defaults had been very low since the 82 recession ended. But they had started to tick up in 1987, 1988, so there's a little bit of a trend there. But the spread between high-yield bonds and treasuries was such that it didn't really make sense to take extra risk of buying more high-yield bonds. And I'll just throw it out there. After working in asbestos, you got to think that these guys are looking at the tobacco companies like RJR, thinking that hey, we just went through this big same thing with asbestos companies. It's about to happen again with tobacco companies. Let's get ready. And I wonder if that was on their mind as well.
I bet it was. Yeah. Well, by this point, Howard is already a highly regarded person in the bond markets. He has a reputation for rigorous credit analysis. He's one of a few people managing a big institutional book of high yield bonds. So Bruce calls him up. He calls him out of the blue, sometime maybe 86 or 87, and pitches him on the idea of marrying distressed investing that he has already had some experience with one of the leading high yield bond funds that Howard is leading. And so, we're going to talk about Oaktree eventually at the end of the episode. But at this point, this is all happening at TCW. And it's worth highlighting that if Bruce doesn't reach out to Howard, maybe there's no Oaktree, right? So if Bruce doesn't make this call, doesn't take action here, maybe the distressed debt market evolves very differently from what we know today. Either way, Howard takes the call. He likes the idea. Bruce comes over to TCW to build this with Howard. And there's an interview where Howard describes why this resonated with him. And Howard says there are two main reasons. One, you have to remember that by this point, Howard is already a believer in high yield. And he has learned that the price you pay matters. We talked about this. And so you can't just follow the herd and do what everybody else is doing. You have to do unconventional things. You have to look for contrarian opportunities. And basically, what do people currently dislike? And maybe you should go focus on that. There may be better returns there. So that's reason number one, right? Looking for a contrarian idea. And this certainly is that. Reason number two, Howard has spent the previous 9 years or so in the high yield bond business. And every once in a while, even though he's doing very rigorous analysis on these companies, every once in a while, one of his investments does in fact default. And the price of the bonds goes from 100 cents of the dollar down to maybe 10. And then they spend a lot of time in a restructuring, a lot of effort with negotiations and so on. And maybe they end up recovering 30. And so he says that to him, to Howard, part of the reason why this resonated is that it's not a great leap to think, hey, let's start a fund to do the 10 to 30 part. Once the bond has already crashed all the way to the bottom, what if we start a fund to identify bonds that have gone down too much and ride up the recovery to something higher? And so he brings Bruce into TCW in 1987, and Bruce starts handling all the analytical work and deal execution while Howard is fundraising and developing the kind of overarching risk management framework for the fund. And I think that what makes Bruce really special, particularly at that time, is that he can read the docs, right? He can read the credit agreements and the amendments and everything associated with a company and a deal. He can understand the priority of claims in a bankruptcy, which is very important. He can figure out what a creditor actually gets if a company defaults. And that is not only valuable, but it's super rare at the time. And funny enough, this is another parallel with Buffett and Munger, right? Because Munger is also trained as a lawyer. And that was a value add in his partnership with Buffett in this whole thing. So by 1988, with the LBO boom still going strong, they go out to raise a distressed debt fund for TCW. And this isn't the first distressed debt fund. Remember those two guys that pitched Bruce when he was working with Eli?
Yeah, Randy Smith and Basil Vasilio. You got to have Basil in there with Sherlock Holmes and Dr. Watson.
That's right, yeah. So they weren't the first. Bruce and Howard are not the first to do this, but this was all still very novel. It's all very new. And if you think about it, it must have been hard to pitch. You're walking in with a story that says, hey, you're going to buy companies that are going into bankruptcy. That sounds kind of crazy, very weird at the time. The way Howard explains what happens next reminds me of the early adopter concept in the startup world. Most people you talk to won't get it. Some of them will, though. And some people will get very excited when you say, hey, you should do this because no one else will, right? You'll be an early adopter of this thing. And here's why it makes sense. And so for those people, combine that with Howard and TCW's reputation for performance and for trustworthiness, and the fact that this firm, Cambridge Associates, a firm that analyzes funds for pensions and endowments, that firm gives the fund that Howard is raising their seal of approval. And you're in the game with this, right? With that combination of variables. And so they did. They raised $65 million by the first close. Actually, by the second close, they got to $96 million. And we should say that Bruce's former boss, Eli, invest it in the fund too, which is a vote of confidence in the market.
So for me, the launch of TCW's distress fund is where the legend of Howard Marks really starts, because in the background of this decision to launch the fund is a philosophy about how markets work that has really, for me at least, taken a clear form with this decision to launch this fund. I'm going to take the risk and try to boil down the Howard Marks philosophy into 3 points.
Here we go.
Let me know what you think. First, markets move in cycles, and they always will, because cycles in markets are actually an expression of human nature. People get greedy when things are good and overly fearful when things are bad. And markets oscillate between those two extremes, with the main oscillation factor, so to speak, being the price of the securities.
Okay. I'll buy the first one. I like it.
Second, you can't predict the future, but you can understand roughly where you are in the cycle, especially at the extremes when optimism is euphoric, 90x for Polaroid, or when pessimism is overwhelming, like we're going to see here from the high yield markets in 1990. The extreme parts of the cycle are when it matters most to know where you are, and that's when the signals are actually the clearest, and you can see them, every day on the street.
Yeah, I like that. So basically, you can't predict the future, but you know where you are in the present, and if you do that better than anybody else, it's just as good as predicting the future.
Yeah, and especially when it matters at the very highs and very lows of the market.
Okay, I'll buy it.
And third, if you have a sense for where you are in the market cycle, you can think in probabilities about the future. The thinking isn't higher yield is always better than lower yield.
Fred Carr.
The thinking is the yield is higher, but not enough for the chance that we have a recession in the next few years. So I'm going to wait, and maybe we'll buy this at a discount then.
Yeah, I like that, Matt.
Yeah, so that's the three, I think. And that framework, thinking in cycles and thinking probabilistically about the future, is what allows us to navigate the high yield market of the 80s.
Yeah, that third one reminds me of one of my favorite phrases, which is distribution of outcomes. Like, you should always know the distribution of outcomes. I think it's interesting, too, to contrast that philosophy that you laid out to Fred Carr from part 4, because the story there really is that you have product innovation, you assume that the economic environment is static to a large extent, and the yield of these bonds that you're buying and the spreads relative to what you're paying out to your customers won't change over the life of the product. And a lot of the reason ultimately why First Executive blows up is because Fred ignored cycles and ignored margin of safety and volatility and probabilistic thinking.
Yeah.
Right.
Yeah. So it's a very, very different way of thinking. And Howard said something in an interview that really stuck with me too. That's a little bit softer and on the personal side. But Howard said that early in his career, he was focused on building standing and building a reputation, where I think Fred Carrs of the world are focused on making money, and they're focused on being smarter. And so that really stuck with me, is the idea of focusing on building standing. So the path to the first fund, it wasn't just Bruce Karsh's experience with the Johns-Manville asbestos deal, but it was also a lot of preparation for the cycle to turn. Although they had no idea when that was going to happen, it probably, in 87, it probably felt like it had to be, in the next 5 years or something like that. And it did happen. The 1989 to 91 period, when the distressed market was really founded, was the third biggest challenge to our financial system since the modern Federal Reserve had been put in place. The only two bigger challenges to the financial system are the Great Depression and the Great Financial Crisis. This period is a lot less known and a lot less studied, but it was pretty brutal for the way the system worked. Remember that in the late 70s, for the first time ever, smaller, riskier companies can raise debt capital using the bond market instead of being stuck dealing with just their risk-averse bank. And there are two things that we have to remember from part 1 to understand the late 80s. The first is that by the end of the 80s, the high-yield market had gone from almost nothing, a $15 billion market in 1980, to being a huge market by the end of the decade. It was $210 billion in 1990, so a 15x growth in the decade. And this market is very important to the economic growth of America at this point in the late 80s. Second, the main seller of high-yield bonds was Michael Milken at Drexel Burnham Lambert. And the main buyers of high-yield bonds were insurance companies, pensions, savings and loan banks, or S&Ls, and mutual funds. Though that group made up about 3/4 of the demand for high-yield bonds. This is a really important part of understanding what happens to the high-yield market in the 89 to 92 time period, because a lot of this demand and supply is going to evaporate in like a pretty dramatic fashion.
Yeah.
Just to zoom in on the S&Ls just for a minute. These don't exist anymore, but back in the 80s, about 40% of regular people banked at these S&Ls, which had existed for a long time but became a major pillar of the U.S. financial system as part of the New Deal in the 30s. and they were the primary channel specifically for residential mortgages. By 1989, about a third of S&L banks were insolvent, mainly due to how they made a ton of really bad commercial real estate loans. How this happened is fascinating and complicated, but for the founding of distressed debt, what matters is that in 1989, deposit insurance for S&Ls didn't have nearly enough in the deposit insurance fund to handle all the insolvent S&Ls. So the George Bush Sr. administration, which came into office in January 1989, passed an act called FIRREA to manage all these insolvencies. And this is 12% of the banking system, right? 40% of deposits and 30% of their are insolvent. So this is huge. And so FIRREA is going to come in and try to manage this without blowing up the economy. This FIRREA Act that laid out a plan to manage all these insolvencies was a big deal. And it did two things that are really important to the founding of distressed debt. First, it said that S&Ls not only had to stop buying risky stuff like high yield, but they actually had to sell all their high yield bonds over the next 5 years. So that's 15% of the high yield market that just goes away as a buyer and puts pressure on the market with forced selling. And it happens overnight. And it's mandated by the government. The second thing FIRREA did was to create a government-run bank called the Resolution Trust Corporation, or the RTC. What the RTC did is it went into insolvent S&L banks on the weekend. It would slide their deposits and good assets to bigger, healthier banks like Wells Fargo and Bank of America. And it would send their bad assets, which are mostly distressed real estate and distressed real estate loans, to the RTC, who would set up trading desks all around the country to sell those assets to investors.
You have to dig so deep into very random sources to find information and kind of put the puzzle pieces together. It is wild to me because it's fascinating and very consequential. And if you think about investors like Howard and Bruce, who are at TCW at this point, who have $96 million ready to go in one of the first distressed debt funds for exactly this kind of turn. Remember from part 4, Fred Carr's high yield portfolio gets taken over by the California government, and it ends up becoming Apollo's first big deal. But before we go deeper into what Howard and Bruce are doing at TCW with all this chaos in the market, say a bit more about the RTC, the Resolution Trust Corp, because I didn't even know it existed until we started researching this cycle, and it turns out to be a huge deal.
Yeah. So the Resolution Trust Corp is a really interesting organization in the history of markets and banking. At its peak in the early 90s, the RTC was the third largest financial institution in the U.S., and its mandate by the government protected 10 to 15% of all regular people's deposits in the U.S. during that time. In this market where distressed debt is being formed, you had this weird, temporary, huge government-run bank with 6 trading desks around the country selling mostly distressed real estate and real estate loans in the market to firms like Blackstone, right? Blackstone's real estate group really got their start buying distressed real estate from the RTC in a depressed real estate market.
I didn't know that.
Yeah. And so while all this is happening with the RTC and S&L's, high yield demand is going to get cut to a fraction of what it was. We already talked about how S&L banks are gone and they're actually selling. Insurance companies, which are the biggest buyers, bigger than S&L's, thanks in large part to what happened with Fred Carr and First Executive, they now have to reserve 3 to 10 times more cash if they want to buy high yield bonds. So they're largely out. That's a huge drag on what the business model was around high yield bonds. And remember, this is not a loss of economic demand that's going to come back when prices fall. This is demand that is just gone. It's been removed from the market by regulators. Politics and media have gone on a complete onslaught of the high yield and LBO market, which really had pensions and mutual funds, which are just very reputation sensitive, and their clients didn't really want them doing this dirty business. They stopped buying bonds. That's 3/4 of the market right there, where demand basically disappears. Insurance companies, S&Ls, banks, pensions, and mutual funds stopped buying high yield bonds in the very late 80s and early 90s. And of course, the elephant in the room we haven't even mentioned is that at this point, Michael Milken and Drexel are by far the largest market maker in high yield. They're the glue that really holds this thing together. They're the sun around which all this orbits, and they get taken out too by the government. Again, by the end of 1990, Drexel is in Chapter 11 bankruptcy and Michael Milken is in jail. So the high yield market is in free fall. 12% of banks have failed. And on top of that, of course, Saddam Hussein invades Kuwait in August of 1990, sending oil prices from $16 a barrel in June of 90 to $36 a barrel in October of 90, sparking an economic recession in 1990 and early 91 that finally tips the stock market into a bear market.
Yeah, and right around that time, In October 1990, Howard publishes the first of his now famous memos, which if you're a fan of backtest and market history and you haven't read some of these memos, we highly recommend that you sign up for notifications and read these when they get published. And of course, recommend that you go back and read some of the older ones because they're fascinating. They're really good writing. In that first memo that he published in 1990, titled The Route to Performance, Howard talks about a director from a pension fund that has beaten the S&P 500 for the previous 14 years. And the director told Howard that they had never had a year below the 47th percentile or above the 27th percentile in performance. And maybe that sounds a little bit technical, but really what it means in layman's terms is that they weren't hitting home runs at this pension fund. It was just consistent singles, just year after year. And that compounded over time. And so because they were so consistently a little bit better than average, they were one of the top performing funds over 14 years. And it kind of reminds me of that speech by Roger Federer, the commencement speech at Dartmouth in 2024, where he talks about how he won 80% of his matches by winning only 54% of his points, which is a little bit counterintuitive, but it's kind of the same thing, right? And in a sense, I think what Howard is doing with these memos is thinking out loud and sharpening his thinking, but similar to Buffett with his annual letters, he's also teaching, right? He's scaffolding this framework for us to think about what it might have been like to navigate these periods in the market. And I think it's invaluable for anybody out there who wants to dive deep into this and sharpen their skills. So let's go back to February 1990. Drexel just filed for bankruptcy. High yields in free fall. The market that powered a decade of restructurings and that powered Fred Carr's Rice and First Executive. The market that financed the RJR leverage buyout, right? The face-off between Russ Johnson and Henry Kravis. It's all falling apart.
There's a real crisis in debt markets during this time period. High yield default rates spiked to over 10% a year in 1990 to 91. In 89, 90, 91, about 25% of the high yield market defaults.
Ouch.
Yeah. The average high yield bond was trading at 66 cents on the dollar in late 89 and 90, and 60% of the high yield market qualifies as distressed debt during this time, which is an extremely high ratio. This is definitely the first time in history that we're seeing a scaled up high yield market have a period of distress, just for the simple reason that it didn't exist before the 80s. It had a period of distress in the very early 80s, and I think it's super relevant actually that Marx lived through that period as well, but it was super small then. And so this is the first time it's scaled up. And this crisis in 1990 is really the founding of the distressed debt industry.
Yeah, and well, Howard and Bruce are ready at TCW with their fund. I think for anyone out there who hasn't navigated a crisis like this, if you're on the younger side, maybe you were around during the COVID shock or maybe the global financial crisis, being prepared doesn't mean that it's all easy and calm. It's not less scary by any means, but it does mean that you have a plan, that you're prepared when everyone else is just reacting in real time. And what Howard and Bruce are seeing in the market probably feels a little surreal. Companies that were issuing bonds 2 years before at 12% yields are now trading at 50, 40, 30 cents on the dollar. Default rates are spiking past 10%. You talked about the Resolution Trust Corporation, the RTC. It's standing up trading desks around the country to sell distressed assets. Insurance companies, S&L banks, mutual funds, basically all the buyers that made up this market are gone. Some of them have failed. In the midst of that chaos, Howard and Bruce go to work.
The high yield market gets most of the attention during this time period, but it's actually real estate and mortgages that were down much, much more. The high yield market was really only down single digits during this time period because of how coupons make up for declines in prices. But real estate prices and mortgages were down 40%. So commercial real estate loans and mortgages, they were a big part of the story of the inception of distressed debt. And remember, this crisis is the third biggest challenge to the modern financial system in history. And meanwhile, Howard and Bruce, they have their $96 million distressed debt fund. It's the second biggest distressed debt fund at the time. They've already deployed some of it. They said they're doing oil deals before this market really cracked because oil prices fell a bunch in the mid-'80s. And they're basically looking for what they would call good companies with bad balance sheets. So they're not looking for companies that are fundamentally broken. They're not looking for companies where the product doesn't work or the market has moved on from that company's product. They're looking for companies that have loaded up with too much debt during the LBO boom, where the deals were being financed with 90 to 95% debt and a small sliver of equity. But the business itself is fine. The capital structure is a mess.
Yeah.
The business is good. What they're doing is they're going in and they're buying the senior debt of those companies, which means they have a priority on the company's assets and the company's value in a bankruptcy. They're not generally betting that the company survives. I do think it's relevant that only a minority of defaulted high yield companies actually go bankrupt. They end up getting restructured out of court. You're betting the assets are worth more than what you paid. Again, it's all about price and margin of safety and buying securities that everyone else is running away from out of fear, not the fundamentals of the business.
Right. I think the math, if you do the work to find the right companies, is pretty incredible. So you can buy senior debt at 50 or 40 or 30 cents on the dollar, and you might end up owning the whole company outright, like once the balance sheet gets cleaned up. And so as it turns out, a $96 million fund is not big enough relative to the opportunities at this point. So in July 1990, the worst year for high yield bonds in history, with double-digit defaults, Howard and Bruce realized, hey, it's time to level up. And so they go out to raise a much bigger fund too. And think about what that pitch sounds like for a minute, right? The entire high yield market is burning. Drexel is in bankruptcy. Fred Karsh company is being seized by the state. The media is running headlines about junk bonds destroying the financial system. Very dramatic. And meanwhile, Howard and Bruce are over here going into rooms with pension funds and endowments, basically saying, hey, now's the time to give us more money. And it actually resonates, right? Because they have a really strong reputation. You talked about how Howard was very focused on standing and they have performance. Their pitch is solid. The math works. And Howard is an incredible fundraiser, we should also note. He comes across as a very humble guy in his memos and in interviews. He's an incredible fundraiser. And you know that because normally when you raise a fund, you have to wait until that fund is at least 80% plus or minus deployed to raise another one. And so they end up raising $280 million in fund 2, but they actually know that the opportunities are going to be much bigger and they may need to move fast because that window is going to close. And so they convince their investors in their agreements with them as they're raising this fund 2 to let them raise a second tranche within that fund 2, a fund 2B is what they call it, which is another $240 million in December of 1990. So in aggregate, their fund 2 is actually over $500 million, which is huge for distressed debt investing at this time. And Bruce puts that money to work really, really fast. They had way more money to work than anyone else. The fund and the returns they end up posting, about 45% a year, really put them on the map as the premier distressed debt investors at the time. And by the way, that was unlevered. That 45% is unlevered. They're not amplifying the returns with leverage. Compare that to private equity, and we studied leverage buyouts. They were shooting for similar, say like 30% rate of returns. They were using tons of leverage to achieve that. Much, much riskier.
Yeah, for sure. So between 1988 and 1995, the distressed debt team at TCW raises about $7 billion and they generate IRRs over 20%. For some context, over that same time period, the S&P returns about 13% annually. And that includes a recession, the so-called jobless recovery, and a pretty sluggish equity market backdrop leading up to the Netscape IPO in 1995. Shout out to our tech and telecom series if you want to go start there.
.com boom.
That's right. This distressed debt fund with Marks and Karsh, it doesn't just outperform, it crushes the equity market. And this really all goes back to cycles. What drives cycles is as things get better, the economy gets better, people become more enthusiastic and drive prices higher. Eventually, the economy runs out of steam and slows down. People get scared and sell. They fly to safety. They ultimately oversell at the bottom. And the point Howard and Bruce make is that that's the opposite of what you want to do. Yeah. You need to understand where you are in the cycle and act accordingly.
I think that's a good summary of Howard's second book, Mastering the Market Cycle. Bruce and Howard basically built a playbook at TCW, right, to identify the cycle, act accordingly, and to be able to act fast and smart in a distressed environment, to raise capital while others are still scared of what's happening and trying to fly to safety, to deploy capital into good companies with bad balance sheets at the right place in the capital structure, and then wait for the cycle to normalize and earn great returns. Eventually, by 95, Howard and Bruce are two of the most respected credit investors in the country. They have raised another fund, Fund 3 and a second tranche, Fund 3B, almost $1 billion, which also delivered great returns. And in fact, they end up downsizing their fourth fund, which is super interesting, right? They tell their existing investors that they can only put 50% of the capital that they had invested in previous funds, which is unheard of. Most investors want to upsize funds, right? Because you get paid on the size of a fund. But the key here is that they see the opportunities are getting smaller, right? The cycle is turning, it's recovering. And so the crisis is over. I think this is what real investors do, right? Like their incentives were to go raise more money and clip more management fees, but they're not driven by the money. They're looking for high quality opportunities. They want to be great investors. They put their clients first. And then in 1995, Howard goes to Bruce to pitch their own firm. They have really strong opinions on how to run the firm. They want to focus on products that they believe in, which they can't necessarily do at TCW. It's not their firm. And they want to become owners in the firm. And that wasn't really in the cards at TCW. And that's how they start Oaktree.
Apparently it was Howard's idea to go out on their own. And he goes to Bruce, who's a good deal younger than Howard. And Bruce told him to come back and pitch him on economics. And so
yeah, it's great reaction.
Yep. Go Bruce. And so Howard pitches Bruce 40% for Howard, 25% for Bruce, and the other partners get 35%. And Bruce says, no, we should be equal. And apparently Howard pretty much immediately said, you know what, you're right. And they both said that being equal partners was the best decision they've ever made. And one of the legends of Marks and Karsh is that they've never had an argument in their business partnership outside of, which high yield bond is better or worse.
Yeah, I love that story. And they're so aligned. It's also a great way to wrap up the series on a really good note. I think sometimes cycles get a bad rap, right? Like the boom leads to a bust, but you don't have to go bust if you know how these work, right? And you know how to navigate them. In many ways, that's the whole point of what we're doing at Backtest. And by the way, in aggregate, these cycles tend to trend upwards and have long-term positive impacts on the economy. So now, Matt, you and I have been talking about a structured way to wrap up each series. So we're going to try this. Each of the series tends to cover a lot of ground. So let's pull back a bit and talk for a few minutes about actionable lessons we're taking away from the 80 cycle. So we each get 4 total. What's your first lesson learned?
All right. So my first lesson is certain kinds of research can create a solid foundation for a new business or market that other kinds of research can't. All right. So hear me out. In this series, we touched on 3 different research breakthroughs. The first was when a sitting Fed president named Braddock Hickman produced a 500-page study in 1958 where he analyzed the returns of investment-grade bonds and high-yield bonds from 1900 to 1943. And this is the research that Michael Milken picked up in undergrad and informed the founding of the high-yield market. The same year, actually, that Braddock Hickman's analysis came out in 1958, Carnegie Mellon professors Modigliani and Miller produced their landmark paper that really changed the use of debt by companies from a moral issue, this is immoral and debt is bad, to an analytical one. And third, we saw Black-Scholes come out in 1973, which is a formula to price options, and 2 Berkeley professors named Hayne Leland and Mark Rubenstein realized you could use this breakthrough to build a product called portfolio insurance that claimed to insure a portfolio of stocks such that it could never lose more than 20% of its value. And so one major takeaway for me after studying these different sort of theoretical academic breakthroughs is the applicability of different kinds of research to starting a business and how that business is going to scale. Hickman's research was really just analysis of something that had happened in the real world, and it was the first time that analysis had been done, so that was the new thing, where Black-Scholes and portfolio insurance were true theories that had never been tested in the market and actually explicitly stated that they required perfect market conditions to be valid and useful. And I think we saw this play out basically exactly how you would expect as these guys went out and built their businesses. Michael Milken scaled the high yield market tremendously well, where the scaling of portfolio insurance caused Black Monday, the worst day in stock market history. The Hickman study even calls out cycles when it said, when the bonds of high yield are purchased amid widespread enthusiasm and rapid new financing, the subsequent record is distinctly less favorable.
We couldn't wrap the series without bringing back the Austrian professor.
So some people like Howard and Bruce listened where others like Fred Carr didn't, and the outcomes of their businesses were radically different. So this Braddock Hickman research, I think, was some really good stuff to start a business and build a market around.
Yeah, I love that takeaway. That's strong. And that quote is still one of my favorites from the whole series. And he told you ahead of time, right? People still missed it. So,
yep.
Okay, my first takeaway is related to that to some extent. And I sort of wrote it out as every boom starts with a fundamental insight. There's something real, right? Like there's real economic value as the engine of a boom, but it eventually turns into animal spirits, into prices going up from people piling on because they're afraid of missing out. And I think back to what Michael Milken did right? Discovering that insight from Hickman, like you just talked about. More importantly, taking action, right? Taking it to its logical conclusion, building a market around fallen angels that were underpriced, and then scaling that market to new issues of non-investment grade, and then truly democratizing capital, right? A financial product that I think added a lot of value to companies and created a lot of growth and unlocked productivity. So if you look at the statistics, that's certainly true, despite the narratives that formed around the time. Over time, though, certainly by the mid to late 80s, that machine that he and Drexel built kind of had a life of its own, right? And some of the deals that they're financing aren't good deals. And this is where some of the bad rap comes from. Some of their buyers are buying these bonds without really understanding the downside risk. They don't really understand the underlying company, their exposure in the capital structure. The fees were so huge. It's really hard to stop the train once it gets going that fast down the track, once it has so much momentum. We're going to see this over and over in financial history. You saw it in the global financial crisis with the CDOs and the things that we talked about in that series. To me, the lesson here is when you see a market with lots of demand, lots of hype, you should really study the buyers. You should see how are they making their buying decisions. You should try to understand that as much as possible. And you should understand the fee structures for the people that are marketing what's being sold. If everyone is just buying and trusting the system, just trusting the narrative and buying on that basis, probably a time to play a little defense, I think.
Yeah, that's a great takeaway. And it brings to mind something that Howard Marks says a lot that I think is from the Galbraith book about financial euphoria, I think, where he says, what a wise man does in the beginning, a fool does in the end.
Yeah.
And so kind of paying attention to, smart people grab on to new scalable ideas in the beginning, but because that idea is smart and scalable, you know where it's going. It's going to go to the fools in the end.
Right. And you can say that too about pretty much every major player in the RJR story, right? Like KKR told investors that they were raising a massive fund to be in the biggest deals. So they had to go be in this deal no matter the price. Shearson Lehman wanted to plant their flag in leverage buyouts, so they had to be in the deal no matter what. Ross Johnson was obsessed with RJR stock price, right? Like literally everyone in that story, every big and minor character in that story is part of this incentives takeaway.
It's a great takeaway. My second takeaway is kind of a dovetail of yours, where it's you have to understand the supply and demand structure of the market you're operating in so you can position yourself for the future. And it stood out to me that in each period you had distinct buyers, right? The go-go stock buyers were mutual funds. The Nifty 50 stock buyers were institutions like pensions. And then 75% of the high yield buyers were insurance, S&L banks, pensions, and mutual funds. And so with go-go stocks in the 60s, understanding that the buyers were mutual funds would have told you that this is all about retail capital flows that either have to be put into the market as they come into the mutual fund, and they can be redeemed at any time, and which made this a very unstable source of demand. And you think you could have known that if you had known that it was all mutual funds. The Nifty 50 in the early 70s, the buyers were institutions like pensions, which really goes a long way, in my mind, to explaining how crazy the valuations got and how it really took like a massive macro event to break the back of the Nifty 50 stocks. The 1973-74 recession and bear market was brutal. And so you could have looked at this source of demand as valuations got out of control in 1971 and said something like, these valuations are nuts, so I'm going to sell, but only if someone pays me a really high price, because these buyers are institutions, and so this can go on for a while. It's going to take like a brutal economic event to knock this off of the trajectory that it's in. And that would have been a good move if you had done that. And then last, we studied the high yield market, where the demand structure for high yield was 3/4 coming from insurance companies, S&L banks, pensions, and mutual funds, which is actually a pretty diversified demand base if you think about it. But if you understood this at the time, you could have been tracking how demand from these sources was on a path to just get regulated away, or there was a chance that was going to happen. There were acts and bills in Congress trying to destroy this market. So a lot of this was happening out in the open. You had kind of known the sources of demand. You could have ascribed a decent probability to the sky falling in the high yield market. I think if you had zoomed out to look at the broader high yield market instead of just a coupon for the deal on your desk, you could have seen that this whole market structure was at risk.
There's also the element of Drexel being at the center of this whole thing. And there was so much concentration risk on Drexel being the major market maker for high yield bonds at this time. And they were already in some legal trouble by 86. The government was going to come after them. And so that's a great point, right? Like it's supply and demand, and what does that look like? And also, what is the structure of the market? Okay, number 4, I think the people that survive cycles, the great investors, great operators, whether you're talking about Bruce Karsh and Howard Marks, or you're talking about what we saw with Jeff Bezos and Joy Covey in our dot-com boom series, these people go to school on the history of markets. And to me, that allows them to understand where they are in the cycle and navigate accordingly. Just think about what Howard and Bruce are doing while Drexel and First Executive are failing, right? And KKR is sitting on what I think may be the worst performing fund of their history. Howard and Bruce are doing something completely different to everybody else. They had understood where they were in the cycle. They were ready. They had studied these companies. They had seen the mispricings play out. They understood what a good company with a bad balance sheet looked like and where in the capital structure was good to invest. And ultimately, they built a huge, very successful firm on those insights, right? Like, it's easy to look smart in good times, but I think the real test is to survive the hard times.
Yeah, it's hard not to study this period and say, okay, we studied all these characters who actually succeeded. It's Marks and Karsh, and what are they teaching us? They're teaching us to think in cycles and think in probabilities. And so that to me, that's the takeaway of this whole series, I think. And by the way, these guys didn't just survive. They went on to run this playbook successfully again during the tech and telecom bubble in 2000, 2001. They ran it in a huge way in the global financial crisis in 08, 09. And they went on to manage over $100 billion and become the go-to firm in distressed credit investing. And eventually they were purchased by Brookfield and are now a part of Brookfield.
Yep. Sure did. Sure made it. All right, Matt, should we leave it there?
Yep, that's a wrap. Thanks for listening, guys. If you want a sneak peek into our next series, follow us on X and LinkedIn. And as always, if you enjoyed this, the best way to help us is to share this with anyone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts.
See you, Matt.
See you later.